Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Corey and Chad here, your host for this weekend's edition, also your host throughout the week on our website, kereport.com, and podcast The KE Report. On this weekend show, we're going to be discussing some of the, change in trends and some of the economic data that we have seen throughout this fourth quarter. Compare that to what we saw throughout this year, and then all the projections next year for what the Fed is going to do and how markets have reacted on the back of those expectations. We are chatting with Peter Boockvar, Chief Investment Officer over at Bleakley Financial Group. Now, Peter, high level, look, we have seen generally weaker economic data in the fourth quarter of this year. Q3 came out with around a 5% GDP number. A lot of people are saying, look, that's definitely the top of almost a blow-off anomaly data point here. But look, the Fed and a lot of investors, I think, are cheering some of this weaker economic data, still a slow downtick in inflation as they carry that over to Fed expectations, and now pricing in rate cuts starting in March of next year and 3 more for the rest of next year. Peter, how are you viewing this weakening in U.S. economic data?
So let's take it piece by piece. So as you say, we had a great third quarter, but slicing that up, a lot of it had to do with inventory build and government spending and basically higher end spending, whereas the lower end consumer, and all you had to do was listen to any retail conference call over the past month, they're more challenged. And if you look at the fourth quarter estimate so far for GDP, it's probably going to be around 1% at best. I wouldn't be surprised after we digest December data and November data in the coming months that it could be a minus sign. So with the consumer, as I said, it's very bifurcated. Listening to Walmart, Target, Kroger, Home Depot, Lowe's, Ross Stores, Burlington Northern, TJ Maxx, Dollar Tree, just to throw out a bunch of names, Foot Locker. And, there's some consistent themes here. The consumer is very discerning, and I've heard the word choiceful in terms of how they're spending their money. You have more people that are making 6 figures that are shopping at Kroger, supermarkets, and Walmart, as we've heard a few quarters now, them saying that. And then you have the manufacturing sector, which is basically in a recession and has been for more than a year, but it's been that way throughout the world. It's a global manufacturing recession, and global trade also being somewhat subdued. So it's a very kind of upside down economy with these different cross currents. And then you look at housing, which is another chunk of the the economy, and that's also upside down, where you have the pace of transactions with existing homes being near multi-decade lows, but on the other hand, the builder business in sort of filling that inventory gap seems to be doing better. Toll Brothers, as on the day we have this, reported a good quarter, and the stock's trading up. So sort of a strange economy, but I still think that the impact of much higher interest rates relative to what we were used to for 15 years still has time to flow through, still has time to negatively impact those that have coming debt due the rest of this year into next year and the year after. So the knock on to the economy, I think, continues. And one last big piece of this puzzle when we look at the economy is the labor market, and we're seeing multiple signs of moderation. We saw that in the ADP report, where the 3-month average is about 100,000, which is quite a downtick from what we've been seeing. In the Conference Board consumer confidence number, those that say jobs are hard to get is at a multi-year high. We have continuing claims that are a multi-year high. So now we're seeing the slowdown in hirings, not really a pickup in firings as measured by low jobless claims, but certainly a pickup in hirings, which is typically the first reaction on the part of an employer in how to deal with a slowing economic backdrop. If this continues, then you'll see the pickup in firings, but just not yet. So I know when I went on there, but hopefully that answered the question, at least on the state of the U.S. economy. And then Europe is basically in a recession. Germany, the biggest economy in that region, certainly is Asia's mixed, with China obviously seeing continued slowdown, but other parts of some strength in Singapore, Southeast Asia, generally speaking, and Japan. So very much a mixed bag.
Well, Peter, just to that theme of it being a mixed bag, a lot of these different segments of the economy that you broke down there, there's bifurcation even within their data, and there seems to be a tug of war between bulls and bears as to which directions things are trending. So when you bring up the consumer, you brought up them being choiceful and discerning, and that certain companies are getting a bid, but where other companies may be pointing out a totally different forecast from their Q3 earnings reports, and as they look into Q4 in the beginning of next year. Manufacturing, it's been weak for a while, but there's other segments that are saying, hey, manufacturing has got an uptick in certain cities, and so people are looking at different data. Same thing with the jobs report. You can look at certain cracks under the surface, but overall people still feel like the jobs market has been stronger than one would expect, considering the macro backdrop of the tightening cycle and a lot of companies having to jostle with inflation. What do you think is going to be the thing that gets the market's moving in a more, I guess, cohesive narrative where either we're in a recession going into next year or we're having this proverbial soft landing? Because it seems like there's not agreement even amongst economists or in the financial media on these topics.
Well, we still have sort of a post-COVID world flow through that has distorted a lot of these data points. Who would have thought that mortgage rates would more than double and home prices would still go higher? That's because, the Federal Reserve's policies turn that upside down. You mentioned the labor market hanging in there. It certainly is. But I think a key reason why we're seeing a very modest pace of firings is that companies spent the last couple of years sort of rebuilding their staff, particularly if you were in leisure and hospitality or owning a restaurant, for example, where your business got crushed with the shutdowns. You lost a lot of people. It's taken a lot of time to get those people back. But now I think a lot of that sort of demand in that sector particularly has been satiated. If you look at the ADP report, you actually saw a decline for the first time in a long time in the number of jobs within leisure and hospitality. But if I spent the last 2 years struggling to build up staff, I'll eat some profit margin just to maintain it rather than just quickly firing them. But I think this is sort of a slow-moving story, but a story that will continue to pick up steam. And I think it's very important from an investor standpoint is to focus on the trajectory of things, because not every economic expansion happens all at once. Not every downturn happens all at once. It happens in different types of stages. We talk about the big sharp rise in interest rates. Well, that doesn't affect everybody all at once. It only affects you if you're either needing to borrow to buy a home or a new project for business, or you have a loan coming due. If you don't have either, well, then at least right now, you're not necessarily impacted directly. I say directly because indirectly you are in some way because it slows growth, but you're not directly impacted by the rise in interest rates. But if you have a loan coming due in 2025, at some point you're going to get impacted. And chances are your borrowing rate then will probably be higher than on the loan that's going to mature. So it's eventually going to get around to you. And that's what makes all this somewhat unusual when you have 15 years of zero interest rates and then you skyrocket up all in 1 year. It has, there aren't really any historical playbooks for that kind of environment. This is just very different in terms of that sort of move in interest rates, really all out of nowhere over an 18-month period relative to the zero bound that we had for 15 years, were obviously negative in Japan and Europe.
Let's focus a little bit more on interest rates then, because they are also a barometer for what people are expecting the Fed to do. And look, the 10-year was pretty much at 5% at the start of November and has moved almost straight down since then into the low 4% range. That ties in with everybody expecting the Fed to start cutting. Where is the sweet spot for, let's say, interest rates? Because boy, oh boy, it has been volatile.
Well, sweet spot, I guess it's tough to say. I mean, I think if you look at short-term interest rates, the Fed's done raising interest rates. The Bank of Canada sat on its hands. The Reserve Bank of Australia sat on its hands. The ECB, the BOE. I mean, these central banks are done raising interest rates. So you can argue pretty easily that short-term interest rates have stopped going up, and they're pretty attractive here at these levels. I think the real question is what happens with longer-term interest rates. And if you look at the U.S. 10-year, as we're speaking here, we're already down to 4.11, astonishingly. But it was 3.75, give or take, in June, July. And then the Bank of Japan decided to widen yield curve control, and then we just took off all the way to 5%. And it was not just a rise in U.S. yields, it was a global rise in interest rates. And as you mentioned, we've since backed off here, but we're still above where we were over the summer. I think that this is more of a needed consolidation of that yield move higher before another leg higher in yields. But it definitely is happening in conjunction with the moderation in inflation stats everywhere in Europe and Asia, and also in the U.S., which is then also triggering the belief that the Fed, forget about raising interest rates again. The market's obviously pricing in now a bunch of rate cuts next year, and that has led to this rally here. But we're rallying. Also, people have to understand because of these worries about growth. And I understand the excitement that maybe the Fed will get out of your face with their rate hikes, but they're getting out of your face for not necessarily good reason. At the same time, just because they're getting out of your face on the rate side doesn't mean they're really out of your face, because they're still going to keep rates elevated even if they cut. Certainly, we're not going back to zero anytime soon. And central banks are still shrinking their balance sheet. So the Bank of Canada sat on their hands, but they said we're going to continue to shrink our balance sheet. The Fed has plans to continue to shrink their balance sheet. In the Financial Times within the last week, I saw an article that the ECB is thinking about speeding up the pace at which they shrink their balance sheet, or at least they cut back on the amount of reinvestments out of their pandemic purchase program. I mean, we're well past the pandemic, and the ECB still has a pandemic emergency purchase program. There is still a level of tightening that is going to continue on, even if central banks, in a way, cut rates.
Yeah, it's a really strange environment to be in, because we still do have some emergency measures in place that you would think would have already wrapped up by now, especially if the economy is supposed to be on somewhat better footing, according to some metrics. But this fall in rates has been a boon to gold. Let's talk about gold, Peter, because it's had a lot of factors, and I'd like to get your thoughts on which ones matter. Obviously, geopolitics and some of the conflict in the Middle East did play a factor, but falling rates and the falling dollar also are a tailwind for the precious metal. People have been buying bonds, which has brought down the rates, but the question is, why are people buying gold? Why are people buying bonds? It's undeniable that gold's had a breakout here. We had the highest monthly close last Thursday, highest weekly close last Friday. So there's some good technical picture, but what is moving gold at this point, and what is its trajectory moving forward?
So the biggest buyer of gold over the last couple of years really began in the second quarter of 2022, that then accelerated into the third quarter, where you saw the highest level of central bank buying of gold going back decades. And it could be on record. I just don't have a chart going back that far. And that was triggered by the U.S. and the EU confiscating about half of Russia's central bank reserves. The amazing thing about gold's behavior over the last couple of years is, since January 2022, so call it right on the cusp of the Fed finally raising interest rates and shrinking their balance sheet, if you look at the 5-year tip yield, you've seen a 400 plus basis point increase in real rates, from about negative 200 to positive 200. You've seen a notable rise in the dollar relative to the euro, yen, and pounds predominantly. And gold hung in phenomenally well in the face of that. And I think a lot of that had to do with the voracious buying from central banks. Now you throw in the historical tailwinds for gold, a softer dollar and lower real rates, and we've seen a back off of about 50 basis points in the 5-year real rate, and that was enough. So gold became this coiled spring, and busting out of that. Now I know it's sort of, again, struggling around the $2,000 level. This last Sunday night, we saw a spike above 2,100 in a short covering, thinly traded Sunday night panic, but I think it's pretty telling, again, how well it traded over the last 2 years in the face of those headwinds. And now you throw in the tailwind, and it seems that there's a lot of further upside potential here if the real rate move and the dollar softness continues.
What about carrying that over to the gold stocks? We saw higher volume come into some of the majors. GDX has rebounded. fairly strong after that breakdown in October and even just in the second half of November. Have you seen a discernible and significant sentiment shift towards those gold stocks that just consistently underperform gold?
I think while we've seen a rise in some of these gold stocks, I still think that people just are apathetic towards it. And that's because, number one, they've been teased before with this $2,000 level in gold. Number two, it's buying miners. You have two different types of buyers of miners. You have those that follow them closely, can differentiate one from the other. And then you have the generalist who says, okay, gold's going up, let me get some exposure, and I'll just buy Newmont, Barrick, and Agnico, the three biggest. And that'll give me my gold exposure. But even with those, there's still this history of disappointment in terms of earnings growth, disappointment in terms of keeping one's cost in line, just constant disappointment. And that there's a lot of sort of scars on people's backs by owning miners over the years. I mean, even just look back from 1999 when gold bottomed to 250 and had its meteoric rise. I mean, these miners just have traded so poorly in the face of that there's just so much still disgust. So I think what you need is a sustained move higher above 2,000 in the price of gold, and I emphasize the word sustained. And that's when I think these gold companies that have all-in sustainable costs, of call it a range of, the really high-quality ones probably closer to 1,000, and the other ones maybe 1,300, where there's some serious profit margin and cash flow generation that's going to happen, some serious debt pay down, that these companies can finally get rewarded. But you can be sure, as human nature never changes, that will happen if, again, the rise in gold can be sustained, because who wants to miss a momentum rise? And these miners are going to experience at some point a good, solid momentum rise, and everyone's going to chase it, and no one's going to want to miss it.
Well, it's going to be interesting to see how things evolve with the precious metals mining stocks, and if they do get that momentum rise, I think a lot of people listening will be happy to see that, Peter. But another market we absolutely want to get your thoughts on is the energy space. When you look at oil and to a lesser extent nat gas, they've been very volatile, but oil really broke out and got above 90 just for a little while. Some of that may, again, have been on the back of geopolitical concerns, but there's a lot of other things going on in the oil market with OPEC and with the cuts in production that were supposed to be there but didn't appear. Well, now oil has dove all the way back down to 70. So what do you make of the oil patch and the related oil stocks?
Well, there's definitely worries about the demand side. There's no doubt, with concerns with global growth. And an OPEC meeting that was clearly, trying to think of the right word, clearly not really firmly across the board of its members dedicated to keeping inventories at bay. Saudi Arabia is trying to corral the group, but I think there was just a lack of clarity in the messaging, and I think that's why we've seen the sell-off. The interesting thing about the sell-off to around 70 is that it's happening when the DOE, Department of Energy, reported their weekly crude oil inventory number that showed a much sharper than expected decline in inventories. So I'm still a bull on energy. I do think that the supply side is going to sort of right-size itself relative to the demand side. And when you look out over, a multi-year time frame, outside of the current cyclical concerns, emerging markets are still going to be the big demand story for crude oil, and that's going to lead to much higher prices in the coming years. But it is interesting to see this. And one has to wonder the state of the global economy with oil trading at $70.
Well, that is the big question, right? Carry that over to the global economy and that weakness that we have seen in oil. Peter, we don't usually talk about cryptocurrencies either, but I do want to bring up Bitcoin simply because Bitcoin has been on quite the run here. It had more or less flatlined through September and October, under $30,000, more around $26,000, $27,000. And then mid to late October popped up to about 34,000 and currently is around 44,000. It's been a strong mover. Any insights on what's going on in the crypto space?
Well, certainly what lit a fire was the growing likelihood of ETF approval to own actual Bitcoin as opposed to owning the futures on Bitcoin. So that definitely was a huge demand driver. And then you throw in just the risk-on picture we saw in markets in November because of slowing inflation, and again the Fed is done raising interest rates trade, so it's rallied along with everything else. The question now is it going to act like gold in a way and sort of be this complement in terms of stores of value that people are looking for, or is it just trading with the NASDAQ, which you can argue is what it has done for the last 15 years, is overlay a chart of the NASDAQ 100 and Bitcoin, and they pretty much have mimicked each other. I think that those that are bullish on gold have soulmates in those that are bullish on Bitcoin, in the sense of, it was created to have something finite that can't be printed by central banks and can be the store of value, because that's all it's now going to be, a store of value. It's not a medium exchange, because every time you got to transact in it, you got to pay taxes. Can it be the store of value that a lot of the adherents want it to be? And maybe so. I'm not going to say that it's not, but I still think that you can't really tell in a 14-year life cycle whether it's going to be the case. And again, it could, but gold at least has 5,000 years of a track record rather than 14 years. So I still think it remains to be seen what Bitcoin wants to be when it gets older, and can it really be that store of value? And we'll see. Maybe it will, maybe it won't. But we have to also keep in mind that it's not really the only finite asset. A 1968 Mickey Mantle is a finite asset too. They aren't making any more of it. And yes, it goes up in value over time, but you don't hear people talking about it like they do Bitcoin.
Yeah, very good point there, Peter. Very timely, too, with the baseball card reference with what happened this week. So, hey, Peter, thank you very much for your time on this weekend show. It's always great chatting with you. Everyone, you can follow along with Peter on his website, his Substack, which is the Boock Report. I will post a link within the weekend show to it, Peter's Substack, where you can keep up to date on what he's seeing in the economic data and market moves. Peter, thank you again for your time. I hope you have a great rest of your weekend.
Thank you, guys. You too as well.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. I hope everybody enjoyed those first two segments, as we are transitioning now over to more broad market commentary here, as well as looking back on the last couple weeks, some key, changes in trend that we have seen in some of the larger markets. We are chatting right now with Mark Chandler, managing partner over at Bannockburn Global Forex. Now, Mark, let's start off with the data on Friday. When we are recording this, the jobs numbers out of the U.S. came out, and payrolls in November grew by just short of 200,000. That was about 14,000 more than expected. However, the prior 2 months were revised lower by a total of 35,000. So broadly, we can call this a wash, I guess. And the market moves on the back of this have been fairly volatile in terms of U.S. markets, which are mostly flat on the day. The dollar is getting a bounce. And even more interestingly, I think interest rates are getting a bit of a bounce after a pretty tough sell-off. So before we get into some of these individual markets, Mark, what did you see within the jobs data here that you think needs to be noted?
Yeah, no, I think you're right. I mean, the jobs data, the headline number seems fairly good. I mean, 199,000, can't complain about that. But when you really strip away the government sector, you get the private payrolls, that was 150,000, and that included about 30,000, 35,000 returning striking workers. So we really are looking at a relatively subdued private sector jobs report. However, underneath remember that the jobs report is really a composite of two different surveys. One's an establishment survey. That's how we get the non-farm payrolls, the payrolls of these businesses. But there's also a household survey. And the household survey showed a jump of almost 750,000 jobs. That is why the news, I think, that was going to lead the headlines is that the unemployment rate fell from 3.9% to 3.7%. Many people were concerned that if we got up to 4%, and we're still there in January, that the SOM rule, which is just a regularity, that unemployment has like an inflection point. If it rises a little bit, no big deal. But once it rises past a certain threshold, then it continues to go up. That 4% is the threshold for January. And we come back down to 3.7%. So I'd say that the risk of this recession signal has diminished. And what makes it all the more important is that the participation rate went up. Typically, when the participation rate goes up, you'd expect some upward pressure on the unemployment rate, but that didn't happen this time. So I think that also the favorable development, and the other development that's favorable, I guess two other ones. One is the average work week. The average hours increased, and this is important because we know that output is GDP. All the goods and services we produce is a function of how many hours are being worked and productivity. So increase in hours worked means that given the tens of millions of people that are working, that increase of only 6 minutes a week is tantamount to a couple 100,000 full-time positions. So output, this is bottom line here, is that there's no sign in today's U.S. jobs data that the economy is on the edge of recession. And I think that the markets responded accordingly, as you would expect, taking interest rates higher as they rethink the aggressiveness of Fed policy.
Well, Mark, let's dive into interest rates a little bit because in general, they've been trending lower. If we look at the 10-year as we record this, it's at 4.24. It wasn't that long ago that we were just talking about a 5% 10-year yield. The 2-year has fallen down to 4.71. Now, today on the back of this jobs report, you're right. They are trending higher. The interest rates and bonds are selling off. But in general, bonds have gotten a bid over the last few weeks. What do you make of the general change in tenor in bonds and in interest rates?
There's been a big drop in not only in U.S. rates, but global interest rates. Think about last week, the week ending December 1st, the U.S. 2-year yield fell 41 basis points, and the 10-year fell 27 basis points. These are just huge moves in a week that did not see CPI or a Fed meeting. This is just a very large move, and I think you're right. The market has come around to the view that interest rates at both sides of the curve have peaked. I think, though, that the price action after the jobs data means that we probably reached a floor in the 10-year yield around 410. And it maybe go up a bit further here. Maybe it's like 450 again. We're about 424, 425 here. But I think there has been a watershed. And again, it's not just the U.S. I think that a combination of factors are doing it. I think the market realized that growth is slowing. And of course, growth has been stagnant in Europe and in Japan this year, and Canada for that matter. And so the real change has been the market believing that the U.S. economy is also going to slow down dramatically from a little bit better than 5% annualized growth we saw in Q3. So I had thought that we'd have a backing up of U.S. interest rates, partly because I thought that the market had pricing in at one point 125 basis points of Fed cuts next year. This seemed a bit aggressive to me, not only in the terms of magnitude, but also the market's confidence of that. Not just a probability, but that really was the odds-on favorite. That's was almost 100% discounted. But instead, I think what's happened is other countries, their interest rates have fallen further. So when it comes to the macro situation, especially policy and the foreign exchange market, I look at the 2-year interest rate differential. And even though U.S. interest rates fell sharply, other countries' rates fell even faster. So that meant that the U.S. premium over Eurozone, over the UK, over Canada, over Australia increased. So the U.S. is still the high yield country among the majors, and I think that is why the dollar has caught this bid here, and especially now after the employment data, the U.S. employment data. I think the market is accepting that, and we've seen a jump in U.S. interest rates, barely retracing though last week's move. I've got the U.S. 10 up about 4 basis points this week. The 2 years up a bit more, 17 basis points. That takes away, say, roughly half of a cut that had been priced in.
Now, this move down in interest rates, yes, it picked up a bit of steam in the last couple of weeks, but rates were moving down all of November after the 10-year almost reached 5%. This has clearly helped out the U.S. equity markets because look at how well the markets have done in November. But even a day like today on Friday, it's interesting to see U.S. markets more flatlining, more neutral as rates continue to move higher. Are you correlating any of your outlook for the U.S. markets with where rates are going, that it sounds like you think they could tick up a little bit?
I do think rates could go up a bit more. That tells me, to your point about the stock market, that we still may struggle a little bit. But I do think that in a broad picture, though, the U.S. economy is slowing down, but it's not slowing down quickly. And that's why I really think that the week ahead is going to be very important as far as how much central banks push against the aggressiveness of rate cuts that are being priced in.
Well, Mark, what do you make of some of the market reaction to the wobbles in the rates that we see in other sectors? Because there are some sectors very triggered by moves in the interest rates, and we've seen some pretty big moves over the last week or two in a number of commodity markets and also currency markets.
Yeah, so to me, there's 3 big moves that are sort of like, I want to say like whipsaw, not whipsaw, but like a whiplash. How fast and big these moves have been. And I know many people are concerned that we've seen a jump in volatility of what's regarded as supposed to be one of the safest assets, U.S. Treasuries. So I do think that some of the volatility we've seen in gold and oil, for example, have really been a function of or part of this larger picture of higher volatility in the interest rate markets. I was amazed by not only gold's rally to record highs, but also the reversal. To me, it was like on Monday this week when we had like roughly $125 range in spot gold, closing lower on the day below the previous day's low, and now we've got some follow-through selling. I think that was kind of a climactic sell-off or climactic rally in gold that marks a top. I mean, a record high, yes, not sustained for more than a few hours. So gold, I thought, was a big move, and I think it partly makes sense. If you think about gold, leaving aside its historic attribute of a safe haven and that, but if you tell me that gold is a non-interest bearing asset and interest rates just fell sharply, I would say that it seems to me to make sense then that non-interest bearing assets do better in a lower interest rate environment. So not just gold, but as we were talking about before, crypto also did well. In the currency markets, the low yielders are the Japanese yen, which is the only G10 currency that's going to close higher on the week against the US dollar, and the Swiss franc, which has also done well, not so much against the US dollar, but really within its neighborhood. And by that I mean just on December 7th, the euro fell to new lows for the year against the Swiss franc. And so I see the decline in interest rates boosting risk appetites and favoring those assets that don't have a yield stream.
So, Mark, to your point about gold and how it did reach those all-time highs, it's also been noted number of times that it closed last month at all-time highs and then closed last week at all-time highs. Is this more bullish longer term then because of those monthly and weekly closes?
I don't know. I mean, I suppose there's some technicians that would say that, but I'm thinking that what we're experiencing today or this week could end up to be a big outside down week, a very bearish development. It looks to me like we're going to close, we're down almost $30 in the spot market here ahead of the weekend. We're going to close below the 20-day moving average for the first time in a couple of weeks. I suspect we're headed towards the 200-day moving average around 1950 or so. And of course, those lows from November are a little bit lower, near 1931, 1932, which also at the time was a 200-day moving average. So I do think there's some more downside, which still makes sense in the bigger macro picture of these relationships where U.S. interest rates may have bottomed, especially ahead of the FOMC meeting next week. And so we could see higher global interest rates and also then more unwinding of this gold rally.
Mark, you also brought up some of the currencies that are most sensitive to interest rates falling, like the yen and the Swiss franc. But how do you see the currency picture setting up if there's a reversal in rates? If we see follow through from what we saw today, where rates start rising again and bonds are selling off, would you expect some of those trends to reverse in the yen and the franc? And how do you, most importantly, see the dollar setting up as we move into the end of the year here?
Yeah, I had thought that there was a solid top to the dollar index, bottom to the euro. Early October, dollar index peaked around 107.35. And the sell off, I mean, we got down at the end of November. So if there was a peak around 107.35, we bottomed in late November around 102.5. And so I think that we're going to be correcting. That is, we should be looking at retracement levels going higher. And I think that we'll see a higher dollar into the end of the year, maybe even into early next year. And it'll be helped by the backing up of U.S. interest rates. I mean, what happened, I think, on November 30th, Europe reported, that's the Eurozone reported, an extremely low CPI number. That gave credence to the idea that they, maybe more than the Fed, they're below 2.5% CPI. It gave more credibility to the idea that they would cut rates more aggressively. And we've seen some profit taking on long euro positions. And so that translates into a firmer dollar index. And we're going to close, it looks to me, like around 104 here today, ahead of the weekend. And I think that we could get back up to the 105, 106 area in the next couple of weeks. And again, it's predicated on the idea that while Europe, and if the Eurozone, the UK, are lucky to avoid a contraction in Q4. The U.S. economy is slowing down dramatically from that 5% handle on Q3 GDP. But today's employment data, and I would expect the next batch of data to continue to show that a contraction, that the U.S. economy is slowing but not in a contraction. And so I look for this dollar index, a dollar more broadly, to rally into over the next couple of weeks, retracing much of what it lost in November.
So, Mark, one other sector that you even touched on there, oil price, and you were saying that the driver also being rates moving lower, but can we also compare that to the economic outlook with some of the weaker economic data that we've been seeing? Because oil peaked right around $90 a barrel at about the beginning of October, moved down through October, flatlined a little bit in November, and then took another leg lower. How do you balance out rates driving oil, but also the economic outlook being a little bit weaker heading into next year?
Yeah, no, I agree with you. I think oil is really more about supply and demand. And most recently, I think it's really been about demand. People are concerned about the weakness of demand. And that's why it's not surprising to me that around the U.S. jobs data, the strength of the U.S. jobs data, we're seeing oil bounce back here. Remember, oil, so I'm looking at the WTI, and we have fallen. This is going to be the seventh week in a row of declines, which really matches the longest losing streak in oil since I think it's like 2018 or so. So I'd say it's primarily demand, but there's also some concern about supply. You know what a lot of people miss because they focus so much on the U.S. strategic reserves. The U.S. is producing about 13, maybe a little bit more than 13 million barrels a day. The U.S. is becoming the world's largest oil producer, and it's exporting about just shy of half of that. And so I'd say that, and not only is the U.S. supply there, but it seems like the market didn't give much credibility to the OPEC's idea of, the Saudis would extend their million barrel cut, and the other countries would voluntarily cut somehow another million barrels on a voluntary basis. And the market's just suspicious of that. We also, reports suggest that Russia is producing a bit more than it admits to, and several other countries within the OPEC family are as well. Kind of interesting. One interesting development that caught my eye was that Brazil is going to join OPEC next year, but says it will not participate in any output cuts. So just kind of interesting. OPEC grows, but maybe a little bit less teeth to it. But this is a big drop in oil prices that we've seen over this run. It began really late October. Oil was near $87 a barrel. So just shy from that $90 a barrel you were pointing out, but almost $87 a barrel. And over this run, we've dropped to today. We're at 69.5. And I'm looking at the January WTI contract. So I do think that this move is a bit excessive in oil, and I would expect to see oil begin recovering a bit more, maybe back up towards $75, $76 a barrel next week.
Yeah, Mark, it's been so interesting to watch these OPEC countries. And if Brazil comes on board with OPEC, a lot of them don't want to cut their production. They want to keep producing. And so that's helped drive the price down. Is that it's one thing to say you're going to do production cuts, and it's another thing to see those countries actually do them. So that's going to be interesting to keep our eyes on. But that does bring into the equation, do these lower energy prices help with the inflation picture? We are going to get an inflation reading in the week to come. But what other data are you watching in the week to come? You've mentioned to us off mic that next week may be one of the last important weeks for a lot of key data. Walk us through what you're going to have on your radar.
Sure. So I do think that the drop in oil prices helps inflation expectations. And we saw that with the University of Michigan's survey. The one-year inflation November number showed an increase. And today, ahead of the weekend, we saw a sharp drop in inflation expectations. The 1 year fell from 4.5% to 3.1%. The 5 to 10 year fell from 3.2% to 2.8%. And in the U.S., we've been seeing a sharp drop, roughly a 20 to 25% in retail gasoline prices. All that should help the inflation picture. And you're right, that's going to be, in terms of economic data, that is one of the big pieces next week. We're going to get U.S. CPI. And it looks like another flat number in November after a flat October reading. So that'll help ease inflation. But I think that the real focus next week is going to be on central bank meetings more than the inflation reading. I think people feel comfortable with the CPI easing a bit more. And the full focus then is on how does policymakers respond? And so we have the Federal Reserve meeting on Wednesday. And there, the important thing to keep in mind is not that the Fed's going to do anything, but that they will update their forecasts. And the September dot plot, they had forecast, the median dot was for one rate cut from current levels. They thought that they would hike rates another time this year. And so if you really look at the numbers, it's really looking at 2 cuts next year, but only one, given that they've only raised rates once. So they've got 1 cut priced in. The market says there's going to be 4 cuts next year at least. And so I'd be looking at what the Fed says more than what the Fed does. And there, keep in mind that the summary of economic projections, their dot plot, is a communication tool and part of the forward guidance they give to the market. The following day, the ECB, the Bank of England, and the Swiss National Bank meet. None of them are likely to do anything. And the ECB is going to update its forecasts as well. And again, here the issue is how much do officials push back? You know, when the Fed met previously in November 1st, the big argument was, well, the market's done some of the tightening for the Fed. And we're talking about the tightening of financial conditions. And Powell mentioned, he said the word persistence several times, meaning that it's not just short-term moves about tightening of financial conditions, but the moves have to be sustained. We haven't seen them sustained. But meanwhile, the market's pricing in that the first cut from the ECB, it's more than 50% priced in for March. And this seems perhaps a little bit aggressive. I'd be leaning more towards a Q2 cut for the ECB. But again, the economy is weak, near stagnation or worse. Inflation has fallen to just above 2%. So there's a justification for it. But I think that a lot of central banks sort of saw their inflation credentials tarnished a bit, whether in a post-COVID environment, whether it's they're expanding their balance sheets or how long it took them to raise rates. Whatever it is, I think that the central banks would probably want to stay tighter for a little bit longer than the market's pricing in. We also get the Bank of England meeting, and the Bank of England's been maybe more successful than the ECB or the Fed in pushing back against ideas of a near-term rate cut. The market doesn't have the first rate cut fully priced for the UK until early Q3, while the market is about, say, 70% chance or so of a cut coming, say, in the first few, say, around the end of Q1, both the Fed and the ECB. Swiss National Bank saw low inflation numbers as well. They're unlikely to cut rates, though again, the strength of the Swiss franc gives them that latitude. I think they too will prefer to be on hold, push back slightly against rate cut expectations, suggesting maybe it's not really delivered also until the middle of next year. The one that's the central bank that's more questionable from the market's point of view is Norway. Currency has been weak. The signal has been that they're not going to raise rates again, but the swaps market is still pricing in a chance that they raise rates again before they cut them. Those are the few major central banks. That's going to be Wednesday, Thursday. But also know that Mexico and Brazil, as far as the emerging markets go, those are the ones that people will be following. Brazil likely to continue to cut rates. That's part of the story of this cycle. Some of those emerging market countries raised rates before the Federal Reserve more aggressively than the Federal Reserve. And now, especially in Latin America, a couple of countries in Central Europe beginning to cut rates ahead of the ECB and ahead of the Federal Reserve. Brazil is one of those countries. Mexico, though, is not. Mexico's overnight rate's about 11.25%. And they're slowly moving towards signaling a rate cut. They have elections at the beginning of June next year. The market's looking at 2 rate cuts by then, but nothing in the week ahead.
All right, so a lot for us to watch out for next week. And then, I think we're all expecting it to get a little bit more quiet as the holiday season comes around. But boy, oh boy, the end of this year, especially November's moves, and now even into December, I'm sure some investors are a lot more optimistic heading into next year, but it has also been driven by slightly lower economic data. And as you said, a big change in investor expectations in terms of rate cuts, and a lot of them potentially coming next year. Mark, thank you as always for your time. It's great chatting with you. If anybody listening wants to follow along with Mark on a daily basis, go check out his website, mark2market.com. I'll post a link to that website within our weekend show posting. And Mark, thank you very much for joining us on this weekend show. Everybody, thanks for tuning in, taking some time away from your weekend to listen to our guests. And please be sure to go back through our website and podcast to listen to all the daily editorials and company updates. Mark, everybody listening, I hope you all have a great rest of your weekend.
Thank you. Good luck, everybody.